Hello, everybody. Big story today. And by the way, President Xi in Beijing, if you're watching, thank you for joining. And thank you, everybody else, for joining too. This is an interesting story. We're going to go into all the ins and outs. There was a lot of money to be made in the past about investing in Chinese stocks, but it's important to get a handle on exactly what's happening to the country right now. We know that the economic growth is stalling, but how badly? And how does it impact everything else? Also, I think the real magic of the story is how everything is connected on the planet. There is no isolation. Sanctions don't work. Don't get in the way of disruption or progression. I think that's the big takeaway. But we're going to dig through a whole bunch of stuff. So we've been working on this one for about 2 weeks. So I hope you enjoy it. And I promise you, you will learn a bunch. So let's jump in. And of course, not investment advice. Who cares about that? And of course, if you want to amplify intelligence, you're in the right place. So first of all, China in a nutshell. I think, 1.4 billion people, 700 million internet users, 600 million smartphone users. We'll talk about smartphones a bit today as well. And $500 billion in e-commerce transactions, of which a lot is food delivery. Believe it or not, it's madness. Let's look at Chinese stocks as well, because this is an investment channel. Not going to waste your time here. But this is from the Kabasi letter, and that Chinese stocks are now underperforming US stocks by the most since the year 2001. That's 22 years, ladies and gentlemen. Meanwhile, China's real estate index is also down a massive 82% in just 2 years. And that puts the index back down to 2008 levels. And we all know what happened right after 2008, global financial crisis. And adding to this, of course, Evergrande a week ago filed Chapter 15 bankruptcy, while China unexpectedly cut interest rates. So is China on the brink of a big credit event? What else is going to break there? And there's a lot of parallels between debt and growth and sustainability, which also is what's happening in the Western world. So we'll try to draw as many parallels as we can as we go through this. Let's look at the top Chinese stocks and the performance over the last 5 years. I'm just going to read out the tickers as we go through pretty fast and do a little eye test for me. So if you look at Baba, that was a big hot stock at one time. It is actually down 45% over the last 5 years. Neo, flat. Billy, up 22%. JD, up 20%. Big e-commerce shop. Sohu, down 50%. Tcom, down 4%. BYD up 443%. And by the way, that's an EV car maker. Baidu down 36%. I was an owner of Baidu back in the day. And I remember actually I bought it in March 2020 when it took a huge dip and it did very well. But it shows you certain things you don't want to hold on to. Li Auto up 142%. BYD in another version. There's BYD DF, OTC, and then there's BYD CBOE up 98%. I'm not sure how they are different, but probably two different holding companies, whatever else. So very mixed, but you want to be on certain narratives. And it looks like here from this, things like e-commerce holding up well and battery electric vehicles, even though companies like NIO, etc., probably not going to make it, they still did okay. So let's look at some of the components that really set China apart in the world. This is CATL and how they lead in batteries. Competition among battery producers, of course, is heating up. Everybody needs them. You can see Korea in there too with LG. But BYD is number 2 and CATL is number 1, the dominant global battery player on this planet. And companies like Tesla have a big partnership with CATL too. And Tesla are working with CATL to build a factory in the US so people who buy American Teslas can get the full credits too. So that's the battery wars. But again, just like solar, Chinese are a dominant player in this area in batteries. Now let's look at what's happening on the ground, and you can see the pinch that how, you can tell exactly what's happening in an economy by how people are tightening their purse strings or closing their wallets. So you can see the development just between 2022 first half to 2023 this first half. 1 year, a massive move from expensive cars to cheap cars. All right, people don't have the cash anymore, and we'll explain why that is later. And by the way, I put in the Lucid logo there. I think they should call themselves Ludic, as in ludicrous, because I think it was yesterday or something they announced they're going to have like a $50,000 car or $30,000 car in the year 2030. It's like, pff, that's called a day late and a dollar short by a big stretch. Anyway, Lucid would give it the new name ludicrous. So, moving on. Tesla, by the way, despite the recession and weakness, Tesla broke ground on the new Megapack factory. Tesla is already the biggest energy storage company in the world. So not only do they have the proximity to CATL in Beijing, where they are building this new factory, but this new factory will be in production in the second quarter of 2024. They just broke ground. They can build these things in 6 months and spin them up and start producing. And the scale of this will be equivalent to Lathrop, which is about 10,000 megapacks per year, which is massive. And again, it's just a car company, but it's not at all, not by any stretch. Now, despite also the weakness in China, the Model 3 refresh orders are 10x higher than what Model 3 orders were before. Orders are through the roof and beyond, so there's no slowing this thing down. People always have money somewhere, and they're finding it somewhere. So let's look at a couple of other aspects of the Chinese economy, because we like Bitcoin too. This is the amount of ASIC miners that are made in China for the planet. 98% are sourced out of China. China dominates ASIC mining manufacturing, but they also do some secret mining too, but the government's not supposed to know about it. So we'll dig into that in the next miner video for Bitcoin. Now let's talk about iPhones, because it's a big part of the economy too. There has been a China Apple iPhone crackdown, however you want to say it. This chart explains how the latest China Apple news is attracting so much attention. So basically, I think the Chinese government is looking to expand its ban of iPhone use for government officials. You're not allowed to bring them into a government building. They think they're spy devices. It's kind of like revenge for what the Americans said about Chinese phones as well. Apple cannot do business in China. Who can? The whole tech industry is caught in this trade war and chip war and sanction war and everything else. So US banned Huawei so they can retaliate. It's all kind of craziness, but you can see this is actually hurting Apple stock, because that is a huge market for Apple. In addition, let's look at the Apple stock chart for a second. That's from Bloomberg. Shout out to Sanjay for sharing it with me literally right before I went live. You can see here, I did warn everybody that Apple faces a lot of slowing in growth, which is never good, but look at it feeling the heat. Probably some of this is from the China fear as well. Apple dips below key technical level, below the 100-day moving average. I tend to look a lot at 200-day moving averages, but this one, the blue line, is a 50-day, way below that, and it just broke the 100-day. Next in the box will be the 200-day. Safe seed, thank you. Good idea to keep your seeds safe. Smart name. Now, let's talk about some of the sanctions nonsense. As we know, this is from Johannes Maria. The US sanctions on Huawei are seen as an attempt to gain an unfair advantage in the global 5G market, despite Huawei's early development of core 5G technology. Huawei is a prominent player in 5G, artificial intelligence, and telco. And while the US defensive actions risk diminishing its technological leadership and global influence, in a nutshell, you cannot stop innovation. It's like you cannot stop Bitcoin. You cannot stop AI. If you try, you're just going to leave yourself behind. And that is how, hopefully, there will be governments one day that wake up to this. Blocking innovation makes no sense. Let me show you. So, the West tried to block China from having access to technology and chips and everything else. But now, Huawei, they have this mysterious phone. I think it's called the Mate 60 Pro, and it's powered by a semiconductor that runs on a 7-nanometer chip that nobody believed the Chinese could build themselves. When somebody took this thing apart, it is entirely sourced from China. So they have the technology, they built it, okay? When there's will, there's a way, as they say. So let's talk about investing in China. It is no longer the most crowded trade. I think it was Q4 2022. A lot of Wall Street people were calling it the most crowded trade, but it's the most crowded trade no more. And the narrative shifted from pro-China investment sentiment to skepticism about not investing in China due to its economic prominence. And despite receiving, I think, about $570 billion in inflows in 2020, this report by JP Morgan Joyce Chang reveals the volatility and fickleness of these capital flows. It is just tanking so far year to date. And it looks like it'll be even lower across both bond and equity investments too. In addition, you can see here, foreign direct investing is also shrinking. Even more telling, foreign direct investment in the second quarter of 2023 stood at, I think, about 4.9 billion, the lowest in the past 26 years, ladies and gentlemen. 26 years. Not good. You know, money makes things go round. And when you start putting sanctions in place and tit for tat revenge plays, you bring commerce to a halt. And that's just not clever. It doesn't work. Anyway, moving on. Let's look at private equity and venture capital activity. You can see the private equity and venture capital activity experienced a significant decline since 2021. The Biden administration's executive order on outbound investment, issued on August 9th, 2023, I think it was, is expected to further smash this investment. And this executive order focuses on specific Chinese strategic sectors, including semiconductors, microelectronics, quantum information technologies, AI, etc. All because of security risks. Again, this will not stop what people want to do. If there's a will, there's a way. Nonsense. They should just shake hands and get along. Cooperation is always better. Now, talking about some debt stuff here, there is the way China's structured. They have a lot of local governments, and these local governments have debt. And that is debt they use and debt they issue to help build projects in these local regions. And the amount of Chinese local government debt is not officially disclosed, but it's estimated to be about 53 trillion yuan, which is about $8 or $9 trillion. And that's more than half of the country's GDP. This makes it one of the largest local government debt burdens in the world. Kind of insane and growing like mad. Again, debt, not good. US is also incurring tons and tons of debt. And this year we'll have about 2.4 trillion in a deficit because of all the debt that they have to service with the high interest rates. Now, also this, some people call it LGFV, which is Local Government Financing Vehicle, i.e. these debt vehicles are reporting that this 9 trillion debt is worsening because they still need to bail out projects, property developers that are facing a lot of very difficult times. And that's a problem. And you can see here the cash in hand to pay short-term debt has steadily fallen. They are not able to pay interest on their debt. It's simply too much. So money printer go burr will happen in China too, like everywhere else as well. Now, housing, per the government data, is resilient. You can see here existing home prices in blue, kind of up, only down a little touch. And the white line is the new home prices since the end of 2010. So if you bought in 2010, you're making nearly 60%. Not bad. If you are looking at existing home prices and you bought one in 2015, you're up 25, 30%. Not bad. But it's government data. So the Chinese, I hope I don't get one of those little poison umbrella things. The Chinese do government data like other governments around the world. It's all BS. It's fake. So let's talk about cooking the books. The creative cooking of the books, again, from the Kobeissi team. You can see here, China cut interest rates on 5.3 trillion of mortgages to support the economy. Back to global financial crisis times. And the move came just after they cut taxes on stock trades and considered banning short selling of stocks. Ooh, interesting. So all these kind of capital controls, special arrangements are just going to blow up deficits. It's all fake and nonsense. Here are some real numbers of what's happening with real estate across China, across all the different regions. If you start at the bottom, you look at Jian, Taiwan, Tianjin, Yantai, Harbin, all down 20% plus. And this is from private data on home prices. Alarming price declines. Nothing like the government data. Who will you trust? Private people's data or the government data? Anyway, also there is a huge amount of non-performing loans. You can look here at the outstanding balance and non-performing loan ratios of Chinese property companies. It's now bundling up to nearly 6%, which is kind of scary. It's very similar to all the delinquencies that are happening in the Western world too. In the United Kingdom, in the US, in Canada, interest rates smash everything. And it's only just begun. So let's talk about, everybody used to talk like 2 years ago nearly, it was Evergrande, 300 billion, roughly the entire public debt of a country like Portugal. Will have knock-on effects. Well, they did disclose their Chapter 15 bankruptcy. But that's only a small potato. Everybody's freaking out about Evergrande. Was it going to cause financial contagion? No. But there's a bigger one. This is what they call Country Garden. They have about 3,100 projects versus the 800 projects under Evergrande. It's far bigger. And the property sector contributes over 30% to China's GDP. And developers like Evergrande and Country Garden engage in very risky practices, including selling properties without completing the construction, a common practice in many parts of the world too, not just China. And Evergrande filed for bankruptcy, as we know, and Country Garden aren't able to service their debt. A big problem. In addition, this is incredible. So it's like a crypto losing 90%. If you're holding a bond on Country Garden, they are now trading at 10% of their face value. So if the bond was worth $100, now it's worth 10. You've lost 90%. And this all happened very rapidly, ladies and gentlemen. And you can see the coupons here out to 2024, 2025, 2026. They all tank at the same level. The further you go out, typically, the more risk, but they're all kind of coagulating with this 10% mark, which is terrible. Anyway, let's talk about Chinese construction too, because a lot of construction as well in other parts of the world are coming to a halt because they're expensive to finance. And construction growth in China, once was the largest driver of GDP growth, has plummeted. So you know this is going to affect Chinese GDP as well down the line. Very simple. In addition, this brings down a fall in confidence. Mr. Weston, good to see you, buddy. Hope it's not too late for you. So Chinese confidence tanks. So basically, if I think 70% of wealth in China is in real estate, I would say, get your own castle. Well, the Chinese took that to the next level. Instead of a third, they went 70%. Anyhow, but the point is, when 70% of your wealth gets a 20% haircut every year, you're going to feel that pinch. And that's going to hurt people and it's going to smash your confidence. Hence, consumer confidence is in the toilet. Another view of that here is this chart. It did take a little bit of a bounce so far this year, but still coming off record lows, but still very close to record lows. All it takes is another rattle and it could shatter people's confidence one more time. In addition, back to debt, China housing debt is insane. The issue at hand revolves around the limitations faced by numerous local administrations. The local governments and local government debt, they have their hands tied. The central government of China intends to permit local governing bodies to issue an additional, I think it's $250 billion, about 1.5 or 2 trillion yuan in bonds to help people deal with these borrowing problems. But if you look at the housing assets versus the mortgages and loans, the net housing assets, it's not pretty. And it's been a multi-trillion-dollar haircut in this industry. And as I mentioned, the 70% of Chinese wealth is in real estate. So if you look at the amount of wealth in China, $85.1 trillion, take 70% of that. That is 60 trillion. I'm missing a zero. Excuse that on there. But China wealth is 60 trillion. 70% of it is made up of property. So again, when things get hit, it's nasty for everything, nasty for how people feel, the culture, the confidence, the ability to raise money, etc. It is terrifying. Now, other stuff that's happening behind the scenes too, which is kind of interesting. Speaking of dollars, China is dumping their dollars. They are selling as quickly as they can US treasuries. They're doing it in London and New York as quickly as possible. And they've been doing this for a long time, but now it's beginning to accelerate because of our friends at the BRICS. They have a plan. BRICS is a big part of the move away from the US dollar. They want to start trading amongst themselves in their own currency. Covered that many times. But also, this is a very interesting angle. Remember I said at the beginning, everything is kind of connected and related? This is stunning. So China's lithium purchases over the last 5 years, China has acquired half, 50% of the lithium mines on the planet. Okay, so lithium is a crucial resource for the manufacture of batteries, as we know, particularly electric vehicles like Tesla, BYD, etc. And there have been acute shortages in the past, and China is extremely strategic. They think with a 15 to 25-year time frame, whereas sometimes Western countries think, quarter to quarter. And the Chinese plan methodically, way ahead of time. And here they're tying up all of the commodities they need for the future. So instead of holding excess US dollar in US treasuries, China has opted to invest in commodities like lithium. and they're building railroads across Africa and across the Eastern world, etc. And this suggests a strategic move to diversify away from US dollar and gain from the rising demand for lithium. Why don't they buy Bitcoin instead? Haha, clever idea. But they need this too. Now, the statement implies China's decision to invest in commodities rather than USTs has left the Federal Reserve and the US banks to finance the US government deficits. China used to buy them before. Now they're taking all of their dollars, swapping them out in London, and buying things like lithium mines across the planet. So they're trading a wasting fiat ice cube for something valuable in the future. Clever. Again, China's very clever, there's no doubt about that. Let's talk about pollution for all our ESG fans. Of course, I'm joking here. We don't have any ESG fans in this channel. But you can see the amount of CO2 emissions. And it says, oh, well, US contributed 13% of worldwide emissions. China emitted 31% of worldwide CO2. But remember, if you think about it, the population of China was 1.4 billion, US 332 million approximately. That's a 4.3, 4.4x. You multiply by, say, 4.35 by 13%, that gives you 57%. So based on population, that would be a fair, equitable balance between the US and China. But the US does pollute a lot considering the amount of pollution per person compared to China, in fairness. So let's get away from that. Now, another interesting aspect. Well, the West is focused on environment, etc. China is building new coal power so fast that the energy transition by the West is completely meaningless. So basically, another way to put that, thank you so much, if the US completely went off coal tomorrow, its plants would be replaced in the same time in China. And that is why a great article here by David Blackmon as well. So it's all really strange. And coal is bad, no doubt about that. But the problem is, unless the West can work with the East, it's all for nothing. That's kind of my point here. Now, let's look at outbound shipments. They dropped by 9% year over year. So China's outbound shipments, slight improvement over the last month or two, but basically they're not doing well. They're not shipping stuff out like they did before, which means as well, other economies aren't buying as much stuff from China. And the other thing as well, China is also deflationary right now. So maybe in a dollar value, it's okay. But the deflation that's hitting China is also affecting the Chinese economy, but they are also exporting their deflation to other countries, which is bringing inflation down in many places. Now, let's look at demographs real quick. This is a bit of a journey today, but fiscal measures alone will not solve China's long-term problems. And this is kind of a few things here which are kind of conflicting. Its workforce will start to shrink significantly in the year 2030. They have had a lot of restrictions on certain things like babies, etc. for a long time. Now they're facing that over-the-hill battle where the population is getting older and the labor force is shrinking fast. It'll go from 800 million down to about 630 million just in about 20 or 30 years. And therefore, they're going to need Elon Musk's Optimus bot if they need workers to do stuff. And that's coming too, by the way. That'll solve a lot of these problems, I believe, down the line. In addition, sadly, 21% of the China youth is unemployed. These are people under the age of 25, and they cannot find jobs. This is a whole labor market transformation. But it's worse than Spain. 28.9% in Spain, 22.3% in Italy, and 17.3% in India. That surprised me. I thought India was just growing like crazy. But anyway, it's bad, but there are worse places as well. Now let's look at the currency too. The Chinese currency, the Renminbi, has reached its lowest point against the dollar since 2007. Remember what happened in 2009? Yep. Falling to about 7.3 to the dollar. And the depreciation follows 4 consecutive months of shrinking exports in China, highlighting again challenges in the country's manufacturing sector. While August exports, a contraction of 8.8% was better than anticipated, like we just covered, but still, it's a 14.5% decline. And it reflects the struggles faced by Chinese exporters due to reduced foreign demand caused by global inflation. And the depreciation of nearly 6% against the dollar in the year 2023 alone, driven by disappointing economic data and a stronger US dollar, the Dixie that we talked about a lot. So a lot of people believe or speculate that the People's Bank of China may adjust the currency band to a weaker level in response to this trend. So you're going to get less for the dollar down the line. So in addition, this is the multi-million-dollar question. Everybody's expecting 5-6% GDP growth for China for the next decade plus. Well, the confluence of factors, including excessive property development and investment, recurring bankruptcies, elevated personal savings, constrictive government policies, deflation, social issues, financial controls, as well as diminishing fertility rate and a population birth rate, all play a role in this scenario. Basically, you need babies, you need workers, you need freedom of capital to be able to drive things. And now they expect this Chinese miracle to end. But it's not that bad. They might not be getting 5 or 6%. They'll be getting 3 or 4%, which is still a lot higher than most of the world as well. So in conclusion, from this long story, and I got a little happy piece of news at the end too. It's brilliant. But basically, the Chinese economy is facing tons of challenges, slowing growth, declining exports, issues in the property sector, really bad issues there. Youth unemployment has reached a record high, causing concerns about job prospects and financial stability for young people. And for a young person to be out of work, it is very damaging, so I hope it doesn't have a long-term effect. Also, Chinese government has adopted a policy of running the economy cold by avoiding massive stimulus packages and focusing on long-term economic sustainability. This is very interesting in contrast to like the US and the Inflation Reduction Act, where they actually spend a lot to build factories. It'll be interesting to come back to this in 3 to 5 years and see which one actually works. I prefer the conservative Chinese method of running the economy cold for long-term economic sustainability rather than just printing a whole bunch of money. Anyway, the property sector in China is also a major driver of economic growth, facing huge issues right now: oversupply, debt concerns, ghost towns, whatever you want to call them. Also, China's economic slowdown has led to uncertainty among investors like us. Are we going to buy Baba stock this year? Probably not. And also Chinese growth prospects impacting sentiment, both domestically and globally. And the big problem with, the whole tit for tat arguing between the leaders. I think Biden referred to Chinese economy as a ticking time bomb. And I'm sure Xi did not like that, reflecting the shifting perceptions of China's economic growth and all the sanctions, which just lead to nothing. And this has led to this clash of economic philosophies between the US and China. So we don't know where it's all going to go. But Chinese new economy, this is what matters. And I always talk about disruption, including high-tech, growth, telecom, electric vehicles, batteries, etc., is a very big part of the world. And of course, all their investments in AI. And it has not been able to compensate fully for the challenges in the property market and other sectors, but I think it more than will in the future. And also, China's economic slowdown is, they have a canary in the mine. They can look at what happened in Japan for nearly 30 years, where the economy went basically nowhere. And they are well aware of that. And they're not going to make that same mistake too. So that is the conclusion. We're not ready just yet to jump into Chinese stocks, but I think the time could come pretty soon. Now, in a fun story, I found this so cute. There's a man in China who trained this blackbird to fly around the city and bring him back money he finds in the street. And he gives the bird a peanut for every note he brings back. And this bird literally goes out, flies out the window. The dog watches him there and goes grabs money. So could be a new idea for a business. I thought that was brilliant. Anyway, thank you all for being here. Thank you to everyone on Patreon who make all of this great stuff possible. Appreciate each and every one of you. Thank you to the mods in the chat and Jeff and Steven and everybody else. Hope you like the show. And I'll see you all. I can't believe we have nearly 2,000 people watching live. Wow, you guys are interested in this really cool stuff. But remember, everything is connected. Nothing happens in isolation. And as an investor, you need to know that. Thank you all. Bye.